So thank you very much, Phil, for being with us in this interview, in which we would like to learn a lot about financial markets and how American people does things differently from European markets. One thing that I have that comes up very quickly when one is reading your profile is all this bet that you have done during your career to the ETF structure as a way of investing. Why do you think that ETFs is better than mutual funds of other structure for a investment, for a mutual investment for investors and also for managers in the United States?
So I was very lucky to be early in my career to be introduced to ETFs on the product development side. And, I got a real expertise in structuring and creating products and managing products, ETFs and mutual funds, but also ETFs. There are a couple of differences between ETFs and mutual funds that favor the ETF, and in the U.S. even more so than internationally. One of those things, ETFs tend to be lower cost. Now, not in every case, you can launch an ETF and charge a lot. You can launch a mutual fund and charge a little. But for the most part, ETFs tend to be lower cost. Now, structurally, the way ETFs are managed, when you buy a share, that process of tracking each share that's bought and moving the shares around is all managed by what's called the DTCC in the US, which is the same piping, the same process that's used when you buy and sell stocks. It's very efficient and very cheap. When you buy a mutual fund in the United States, that process goes through what's called a transfer agency, which is an entity that's set up at the mutual fund company to track all the different purchases and redemptions. And that becomes a little more costly for the ETF issuer to run. It's not a tremendous difference, but it is a difference that helps create some of the cost efficiency. The other difference is in the US specifically, the tax treatment of the two structures are very different. In the ETF, there's a mechanism by which the fund can wash out all internal capital gains, which means if you buy a stock at 20 and you sell it at 40, that creates a gain, which is a taxable event. But in the ETF structure, you can switch out the cost basis of the underlying stocks that you can't do in a mutual fund. So there's a couple of nerdy structural differences why ETFs are better. But I think when you look at now how portfolios are being constructed by most investors, most people want access to liquid, easy access to their investment portfolio. If I want to buy gold, I'd rather buy it in my equity account in the form of an ETF than go store a gold bar. And different asset classes and strategies that are now being made available as an ETF, it just becomes a more efficient way, in most cases, a more efficient way to access them. Now, there's also downsides, right? So with an ETF, you have to buy it on the secondary market, which means you have to be a bit of a trader. You have to understand what the real-time value is of the fund. You have to understand how to, buy without creating market impact, without moving the prices of the ETF. So there's, a little bit of a barrier too. But by and large, I found ETFs to be the most efficient vehicle out there to access investment strategies. So the question becomes, well, how do we take sophisticated investment strategies that have not always been available to individual investors, that are more hedge fund strategies or alternative asset classes, and make those strategies available to investors through the ETF?
And you are saying one thing that for me is quite very important and very different also between the US market and the European market. And it's the possibility through ETFs to get strategies, active strategies that are managed for great managers. And in Europe, we understand that ETFs is something to use when you want to make an index strategy. You are going to buy an index, or you are going to buy some, materials or basic materials, or petroleum or something like this, petrol or something like this, oil and gas, or at the most going to sectors. But in the United States, and I want to go a little bit deeper with you to this, you can buy different strategies that, as you say, as you have said, maybe there are more hedge fund strategies, but you can buy through ETFs, and this is a quite a super interesting and super cool thing that you can do in the United States when you are a retail investor through the ETFs.
Yeah, it's incredible. The proliferation of strategies. There's a big joke and a lot of skepticism around the saturation of the market. And so many ETFs and strategies have launched. And a lot of people are very skeptical about it. Oh, everyone's trying to sell us something and there are too many ETFs. But in reality, if you really take a step back and look at it, you've got strategies. We were at Exponential ETFs. We were managing as sub-advisor a couple strategies. Let's take the Black Swan Fund, ticker SWAN, or the Risk Parity Fund, RPAR. These are strategies that up until a few years ago would have been 2 and 20 strategies. That means 2% management fee and 20% of the performance of the fund goes back to the manager. Now, we can automate the processes. We can manage these super efficiently and bring them to investors at a cost well under 1% all-in management fee. It's all transparent. You can know what the fund is holding on a daily basis. It's liquid. It's an incredible thing for investors. So I think a lot of the skepticism is a bit misplaced. I think it's really a wonderful thing for investors.
Yeah, I think so. And also I think that in European markets, we have a great path to do to understand which is the powerful of the ETFs and how the American people is using ETFs. I want to ask you one question, and is how one guy, as you did, raise $1 billion from the scratch in 3 years, launching a company. This is quite incredible, no?
Thank you. We're not a distribution company. We've never been a distribution company. So we never really focused on sales. We launched a couple of what we call proprietary funds. So funds that were based on my strategies. And they did not do that well in the market in terms of gathering assets. Where we were able to gather a lot of assets was on our sub-advisor business. And what we were doing is we took our portfolio management team and we automated as much of the process as possible so that we could be super, super efficient in managing the taxes and managing the secondary market of the fund tracking the indexes, what's the spreads and the depth and the market maker participation, all the portfolio management and capital market functions. So when we created that, we went out to other ETF issuers and mutual fund companies and said, hey, we can manage your funds for you in a super efficient way. So when we raised the assets, it's really other people's funds and other people raising the assets. We were servicing the funds as sub-advisor, and it was an offering that was, really took off, was very popular because we could be super efficient. I mean, the other, when we talk about how wonderful the structural advantages are of the ETF and how it's democratizing access to all these strategies and making all these strategies available, the other side of it is there's been this intense fee war in the United States and really globally we're starting to see it. And that too is a great thing for investors, not such a great thing for the asset manager, right? So we're seeing now strategies launched in the single-digit basis point range, by the likes of Vanguard and BlackRock and JP Morgan and Goldman Sachs. So if you're an independent asset manager and you want to compete against these giant corporations, they're charging, let's say take an example, they're charging 10 basis points for a strategy. I think I could do it a little better. But as an independent, you can't charge anything close to 10 basis. It's just not possible. To reach a scale, to make those fees feasible, you need to be a massive, massive corporation. So it becomes harder and harder for the independent asset manager to be efficient. What we were doing was taking the efficiencies that we created as a company and offering that to other companies so that they too can become as efficient as possible and, compete as best they can, compete on fees. Anything we could do to lower their expenses is a win. Win for investors and a win for the asset manager.
This is awesome story because, one of the things that you can see in the financial markets nowadays is that problem of fees, small fees that they are making that the big companies became bigger, and it's day by day more complicated for individual, managers or for small managers or for small advisors to live and to compete in this market. Do you think that this is a trend that we will see more and more in the market? And finally, all these big market of financial assets, they will be only in few big hands?
Well, it's going that way. It's headed that way. I don't think it'll get there. I think the pendulum will swing back, and I'll tell you why. What we're seeing now is there's an extreme focus on fees and a focus on cost, not cost benefit, right? But cost. And ultimately, for a fund, let's say there's an expensive fund, right? For that fund to be feasible in the market, it has to provide returns in excess of the excess fees, right? I mean, it stands to reason. If I'm going to ask you to pay more for a premium product, that product has to be premium. And the premium in our industry is very easily defined. Is it outperforming? And is it outperforming by enough on a risk-adjusted basis to justify the higher fee structure? We are coming off a market cycle where the cheapest funds, right, where the pure beta, the market cap weighted index funds have performed the best. There's been just this runaway train of these FANG names in tech where they've just taken a bigger and bigger allocation of market cap weighted indexes. So the cheaper funds have not only been cheaper, but they've also performed better than the more expensive funds. The value manager that truly understands everything going on and within a company, here's the real intrinsic value, they read all the reports, they know management. That manager has provided no value over the last few years just because the market cycle has not been favorable to him. The hedge fund is using all sorts of factors, and I mean really nothing has been working. So we're coming out of an environment where not only are the cheaper funds cheaper, they're also performing better. So it's hard to fault the market for not just for just blandly just going in without thinking too much, going into the cheaper funds, market cap weighted index funds. But I do think that will change. No cycle goes forever. The largest companies that are now the top 5 companies, I mean, they're eating the highest percentage of the market cap weighted indices that we've ever seen in the history of market cap weighted indices. And I've been talking about this for 3 years. I was looking at it at the time. I said the top 5 companies were 15% of the index. Then I gave a presentation. The top 5 companies are 18%. Now I think they're 22, 23. I mean, it just keeps going. And it seems like there is no end in sight, but there is an end in sight. There's always an end in sight. 5 years ago, people were talking about, other companies. 10 years ago, you go back, General Electric or Nokia or, different Exxon was an unstoppable force. And people forget now. They look back and say, oh yeah, Sears was okay. It had its day and it was a good retail company. People don't realize, no, it was a dominant retail company. And, mom and pops were saying, we can't compete with Sears and Macy's. It was the same arguments being made today. But disruption comes, and it comes. It's always around the corner. I don't know where it's coming from. If I did, I'd be in that business. Nobody knows where it's coming from, but we know that things don't stay the same, that disruption does come. That's a cycle of things, and the pendulum will swing back. When it swings back, it stands to reason that those factors, and I don't know if it's going to be, value or size or different sectors are going to come into play, or what unforeseen event will be the impetus and will spark it, but something will come. And when it does, there will be products that will outperform, that are more expensive because they can charge a premium because they have certain expertise, or they're doing things a little differently than market cap weighted indexes. And then people will be able to point to the returns and say, all right, this does make sense. This is feasible. Things will not go in one direction forever. They never have, they never will, they never do.
This is awesome discussion because, I was not a long time ago talking with a financial advisor. He has, wealth clients, and he was telling me, man, I'm totally destroyed because every time I'm telling my clients, don't buy that is expensive, these stocks are growing and growing and growing. And once I'm telling my clients, buy that this is cheap, they are going down, 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 and down. So I don't know what to do. I don't know what is going on in the market, and I don't know why the expensive things are growing and the cheapest things are going down. This is one thing that we are saying in the whole market, and it's changing a lot of things, and it's damaging a lot, a big part of managers let's see value investors, or let's see another kind of managers that they can't say again value investing is gonna come back. As you say, this is gonna come back, but when is a problem, and where is a problem? How do you see the strategies that can, or because these ETFs that they are managing different strategies, how do you see, or how do you can find strategies that are performing, not so bad in this real situation that we have right now, but can perform very good in other situations?
You have to look at things on a longer time frame. You have to just broaden out, take further and further step back from a high level to be able to evaluate. You can't look at what happened. Let's say that the biggest companies are getting bigger, and there's structural, because of the internet and because of structural reasons, that it's never going back, and the bigger companies are going to go back. Okay, well, extrapolate that. Extrapolate the higher expected returns of Apple and Amazon over not another 1 or 2 years, over 100 years, over 500 years, right? You get to a point where it's just ridiculous. It's going to be over 100% of the total global market cap in I think like 12 years of this type of compounding. It's impossible. You just have to take a longer view, and look, the market will test your patience. The market will always test your patience. You're never going to get into a trade on the perfect day and the trade's working for you from the beginning. The great movie, The Big Short, and the book, of course, as well. My favorite part, because I thought it was the truest part, was when they got into the trade and it was moving against them. And, you have Michael Burry, going to the whiteboard, and, they're down, however much he's put, updating the whiteboard, and, his investor, he has to side pocket the money because the investors want to pull out. They were wrong before they were right. And they had to, really test their conviction. They didn't get shaken out of the trade. They stayed the course. And if you look at the dot-com bubble, and you look at how Warren Buffett performed during the dot-com, I mean, people said value's dead. It's over, right? This is a change that's, that's never going to reverse. That the market's different now than it ever was before, and value doesn't work anymore. Buffett had underperformed for a few years there by like dozens of percentage points, not basis points, percent. I mean, he was, getting killed, but he stayed the course. And, that's really the whole thing is, any strategy that you get into, whether it's value, whether it's momentum, whether it's active, micro caps, it doesn't matter. Whatever your strategy is, if you have to have enough conviction that you don't get shaken out of the trade. Otherwise, you get blown around like a leaf in the wind. And anytime the market starts moving against you for a prolonged period of time, you say, "Oh, forget it. Value's done. I'm jumping onto Tesla at the highs at an insane valuation that makes no sense." Well, you know what? If you were bullish Tesla on a momentum or a paradigm shift tech thesis, okay, there's not, you've been right over the last couple of years, and I'm not going to say you were wrong. But if you were in that trade from 3 years ago, or even from 1 year ago, okay, to come into it now after it's run up the way it has, I think it is foolish. And so, you have to, from the beginning, you have to say, you have to plant your flag. You have to say, this is my investment thesis. I'm a quant, and I'm going with the factors that have worked historically. I'm a value manager. I want to understand these companies, understand their intrinsic value, buy them at a good price. I'm a momentum guy. I'm just going to, follow the trends and stay with what's hot. Whatever your thesis is, it's valid. It's fine. It can work, so long as you don't get shaken out of the trade when it's moving against you. And, the important thing is to pick a strategy that makes sense to you. Right? That makes sense to you, that you understand what you're buying, that you understand the strategy and why, because when you have that connection to the strategy, then you won't get shaken out, right? If you believe that, the move to autonomous cars and electric cars is a whole paradigm shift in the world, so you're long Tesla, well then if Tesla drops, 50% in a month, which certainly could happen, you're not going to get shaken out. You're going to stay in. So too, the value manager will be able to stay in because they believe, look, I'm not just buying, letters and numbers that are moving around. I'm buying real companies that are producing real goods and services that has value. The company has value. The brand name has value. The goodwill and the customer loyalty has value. The revenues that they're bringing in, there's a price that I can put on that, and I own it at a price better than the price I'm putting on it. So I don't care what the rest of the market's going crazy. I don't care what's doing. If I'm underperforming a benchmark, I know that I own good companies at a good price, I can stay the course. And having that conviction is the most important thing to be able to stick with the strategy over the long term.
Yes. You are talking as Peter Lynch or Warren Buffett or these great guys that they were, running with one strategy and knowing what they were buying and knowing why they were buying that and knowing that, and so they were confident in the things that they were doing. And what do you think about, because, today there is also talking that relating value investing and technology. You see the movements that Warren Buffett have done into Apple and now into a pre-IPO company, technology company, very recently, this week ago. And most of the people is saying, okay, value investors have changed into the technology because technology is the future and we are in a big disruption right now. You were talking, and so what do you think about that and this talking about value investing and technology and why value investors are going right now to the technology sector to buy?
I think the market's very simple, right? Business is business. You buy for $1, you sell for $2, right? That's what business is. Any business needs to generate money, needs to generate cash flow, and have good financials. When we buy stocks, very often we forget that we're buying businesses, right? We're buying companies, and the purpose of the company is to generate cash flow. Every company, you can very clearly, but you can come to a conclusion of what you think the company is worth from an intrinsic value standpoint. And I think the market needs a mechanism whereby there's a true up between what the market cap or what it's trading at and what the intrinsic value is. And when you lose that, when that's disconnected, when the price, the stock market price of a company has nothing to do with what the company's worth anymore, it's a bet on something else. It's a bet on what is Jerome Powell going to say. It's a bet on, there's nowhere else. Tina, there is no alternative. There's nowhere else to put the money. So we're just going to put it into stocks. And when you say put it into stocks nowadays, more often than not, you mean put it into market cap weighted index funds, which means 20% in Google, Amazon, Apple, and Microsoft. So, you're betting on these things, not based on, well, I think Microsoft is worth a certain amount of money because they're generating a certain amount of money. I expect that to grow, but you're betting on these other factors. And, I think the move towards it, clearly from a macro standpoint, there is a move in our lives towards more and more technology. That's never going to go away. That's been the case since we were all children, and, slowly, incrementally. And, there are people who think we're on the verge of, exponential growth in technology. Maybe so. But at the end of the day, it still has to generate cash flow for the businesses, right? User growth and global adoption doesn't mean anything. It's cash flow. Is this company going to create cash flow? And is it going to create cash flow at an increasing rate greater than the market expectations? Well, how can that be when the market expectations are so high for so many technology companies? There's only so many dollars to go around. I'm only going to buy so many apps. I'm only going to buy an iPhone every 3 years. I'm only going to buy, so many products through Amazon, and people are coming for everyone's margin from every angle. So there are going to be winners and losers, clearly, but the idea that all technology is going to continue to grow exponentially at the expense of every other business that is generating cash flow, it's a little bit of, what was famously called irrational exuberance. Not to say that, bearish on technology is an increasing component of our lives, but in terms of simply generating cash flows, because we can't lose sight of what we're doing, right? We're investing in businesses. Businesses, like I said, buy for $1, sell for $2. You distill it down to its most basic, simple elements. And then, I think you can see that, technology is tremendously important, more so than ever, probably going to continue to grow in importance. But as an investment where we are now, with the expectations that are priced in where we are now, and with some of the financials of some of these companies, I think you could say if you're in, then great. But if you're not in, you may have missed the boat.
I saw this thing very interesting and very related to one thing that you were saying before, That is how you automatize your company, the portfolio building of your ETF company, trying to get it tremendous efficient to be able to be in the market. And for me, this is related because this is what we see in every single business today, and more if you are small. You have to be totally efficient to be in the market, to compete in the market, and it means technology. How much of technology application was in this efficiency of your company, and how much this technology view was in your way of doing business in the financial markets?
Tremendously important at every step. And I spent 6 years at the New York Stock Exchange. It's technology, right? You're just connecting buyers and sellers. Every company now is incorporating technology. Everyone's the secret's out. I mean, there's no edge there to say that, hey, we're going to try to automate and add technology to what we're doing. And what I'm going to be, shortly announcing, what I'm going to be doing in the future is even more heavily reliant on technology, but to the point of making life easier for our clients who are investors, financial advisors, institutional investors. And I mean, the key thing here, it's not technology for the sake of technology. You're solving solutions. And it's the same as a company that's not offering any technology. If they think about it as, what are we providing for the customer, right? Who is our customer, and what are we doing to make their lives easy? If you can use technology to do that and to create efficiencies and to bring down operational costs, that's great. But if you can do it without technology, by maybe going the other way and saying, okay, we're going to be there for you. We're going to pick up the phone. We're going to help you. We're going to explain things to you. We're going to talk to your clients. We're going to, provide value in different ways. That's just as good. The idea that it has to be technology and that's the only solution, I think we've gone a little too far with that. Certainly in the venture capital space, where the idea of a startup is now synonymous with technology, right? You talk to VCs now, it's all technology. That's it. That's the only thing they're interested in. And if you have a really good service business, or you have a business that's in, let's say, you can buy up dry cleaners now. They're all under stress because of coronavirus or something like that. There's not a lot of interest, which, again, there's, I joked on Twitter the other day, there are no value investors in venture capital. They're all growth investors. They're all right? They're all piling into the trend. I guess you could say, that's kind of the role of private equity, but they're usually looking on a bigger scale. But when you go ground up, technology is important. It's critically important. It's increasingly important. But that's become so common thought that I think there's even more edge going the other way. If you look at how would you attack Amazon, right, as a company? Well, are you going to be able to deliver items for less? Are you going to be able to be more efficient than them? Probably not. But when you have a problem with Amazon, it's not that easy to figure out who to talk to. Or if you have a question, you want to talk to somebody, or you have a special, an important purchase that you need a little more handholding for. So, you might want to think about addressing it from a low-tech standpoint. The more tech is in our lives. Look, I find I spend all day on a computer and a phone, like most people now. And at the end of the day, I have this hunger for, doing some woodworking or creating something with my hand, or I start reading, books, paper books, instead of reading on a Kindle. And they're I think our bodies are designed to be out in the world, to use our hands to build things. And the more and more and more technology encroaches in our lives, I think the opportunity is to go around the other side and to say, okay, how can we solve problems, not just with technology, but also using basic, timeless business principles, solving problems for customers, and building relationships that we can ultimately, be beneficial from a business standpoint to all sides.
That's awesome. And so with this talking, how do you think EA, artificial intelligence, that is right now going inside the financial markets? We see right now a lot of hedge funds that are managed through artificial intelligence strategies. Also, we see how you can invest in a lot of companies that are applying artificial intelligence in different business. How do you see the beginning of the artificial intelligence in the business, in the financial business, and how can this change more even, if we can say it, the environment in which we are living in the financial markets?
I'm generally disposed to be skeptical about AI strategies. And the reason being that technology is a continuum. It's always going to get better, right? So we're going to get more and more efficient. Any artificial intelligence program that is, picking stocks or picking sectors or, trading, whatever it is only as good as the inputs, right? The data that comes into it, what's it looking at? A computer can't get creative. Even an artificial intelligence program can't get that creative. They can only look at the variables that are programmed into it. And those variables, if there's no edge in the inputs, then there's no edge in the outputs. Now, they can be hyper efficient, they can do things well, but technology is a continuum. So, just like we look at the computers that we had as a kid, and we laugh, say, oh, look at this giant box that sat there, and now, my little phone is 100 times more powerful than this big fancy computer that my dad used at work, or whatever it is. It's going to be the same thing. In another 20 years, we're going to look back at the AI that we had today, and we're going to laugh at it. So even if you design an AI program where you have some edge, you're vulnerable to somebody else creating a better program that's aware of what you're doing, front running you, taking advantage of you, and then creating edge on top of that. And these things, we've seen this in the markets before. We've seen this with high frequency trading, where once the technology gets out, so you have one company has some edge, and they create this great Delta One arbitrage mechanism, and they're making markets for, let's say, derivatives. And then all of a sudden, there's one technology employee there who's disgruntled, thinks they should be paid more. They go over to their competitor. All of a sudden, their competitor has the identical thing. And then another firm somehow gets an identical thing. And now what happens? Well, your 2 penny arbitrages go down to 1 penny, go down to a half a penny, go down to a tenth of a penny, and they keep edging each other. And then all of a sudden, the whole high frequency trading thing, everything Michael Lewis wrote about, those firms aren't doing that great anymore, right? There's not a lot of edge anymore. They've arbitraged themselves. They've cannibalized themselves to the point where that edge has disappeared. And I think we're going to see the same thing. If there is edge in artificial intelligence, that technology, that technology can be replicated. That technology can be bettered. And I think it's going to be very hard for a firm to, create some sort of black box model that's going to be able to stay ahead of the markets indefinitely. I'm very skeptical of that, but hey, it's possible.
Well, I think that always you have to mix some kind of technology and some kind of human intelligence to get forward with a good idea. We are ending this interview, and I don't want to finish without asking you how an investor, a European investor that want to invest in ETFs strategies in United States can find value. If you think that there is value in all these kind of new strategies that are appearing through ETFs that we can see in the US market, that they are a lot of them, and how we can find value in this ETF environment in the United States.
So the wonderful thing with all these strategies, there are so many different strategies now that you can look at. And, we talked about 2 things. We talked about having conviction in the strategy that you're in. And we talked about, combining the technology with the human element. And I think both of those themes are really important when selecting an ETF. Conviction means you have to, the strategy that you're allocating to has to make sense to you. It has to connect with you, right? On a real level. It has to be personal to you, right? And that could be, look, momentum just makes sense to me. I don't love anything. I don't really care. I just want to be in whatever's hot, whatever's moving, right? It could be value. It could be, any sort of thing. But if a strategy clicks and it makes sense to you, then you're going to be able to stay in. You're going to have conviction. You're going to be able to stay in when it moves against you, which means you're going to be in it still when it bounces back and moves for you. And that's the most important thing. So, the other half of that, like I said, combining the human and the technical part of it. So forget about the AI and all that, but you need some sort of, empirical understanding. You want to either, if you're not running a full optimization, you want to have, the technical skills. And if you don't have them, there's plenty of great software out there that can give you, that you can run all sorts of, all sorts of optimizations, and you want your portfolio to be on an efficient frontier, and you want to make sure that you're cognizant of diversification. And remember, if you're in a value fund and a growth fund for U.S. equity, you're not necessarily diversified. They're very highly correlated. So you want to think about true diversification to alternative asset classes and alternative strategies, but you want to combine the human with the tech. So once you have a baseline of what your portfolio should look like from a technical standpoint, be that either you're optimizing historical backtests or you're forecasting forward, it doesn't really matter, but combining the human, which means also making sure that those strategies and those managers and those companies, I'm not saying stocks, the businesses, the companies, right, that you're buying, that they make sense to you. Because if they make sense to you, even in a down market, even when things are moving against you, you're not just going to sell on the lows and chase things on the highs. You're going to stay in, you're going to have conviction, and that is the most important factor for long-term success.
Great. And how can you say about that you have 2 patents in ETF structure? So how did you get to that, to get some new things in ETFs structure?
You got to be open-minded. It's as simple as that. You got to be intellectually curious and open-minded, and look at different strategies, try to understand them. Why are people launching them? Not just, there are too many ETFs and the S&P 500 is working just fine, so I'm going to stay in that. Look at different strategies that are available to you. Consider the cost. Something that doesn't have a lot of assets, that doesn't mean that it's a bad investment. The assets are going to chase historical returns. They're going to be driven by distribution from larger companies. That's not necessarily the best place where you want to be. You don't want to write that off either. But you want to evaluate the investment merit. So, what is the thesis? What is the environment under which a certain strategy will do really well? Do I expect that environment to come in the future, or do I expect a continuation of the present, or the recent term historical? And once you have that framework, people say, active is like a sin. You want to go passive, and there's a lot of evidence, empirical evidence that points to active underperforming. But that doesn't mean that you can't take a view of the world. It doesn't mean that you can't say, well, I think central banks are going to keep interest rates artificially low for the next 10 years at least, right? You can take that view. And once you have a view, you can say, any number of macro views or a way that you see the world. Maybe you are a technologist and you think technology is going to continue to run forever. That's okay. But then you take your view and you say, okay, given that this is how I view the world, what are the strategies that are going to be best under that circumstance? And then you can pick it that way. And that's why you're still using systematic processes. You're still using, either funds or companies or whatever you're using to access your investments, but you're still enacting your view, but in a way that's not just like churning active management where you're just, trading really quick, in a way that really makes sense to you. And again, all part of it is having that long-term conviction and picking strategies that are going to allow you to have the long-term conviction.
Great. So where do you think that ETFs structure as a way of investment, how it is going to go in the next coming years in the United States? Do you think this is going to grow exponentially, and also not only in the United States, but it is going to grow out of the United States in this way that the United States is signaling as a way of doing new strategies through ETFs? Do you think this is going to grow? And what is Phil Bak going to do in the next years coming? And what do you expect, for the financial markets to give you and to enjoy yourself working on them?
I do think ETFs are going to continue to grow. You look in the U.S., you look at the mutual fund market is huge. It's over $15 trillion, way bigger than ETFs, closed-end funds. So the ETF still has a lot of room to grow just from taking more market share from the other product structures. A lot of people are very excited about direct indexing, so being able to access strategies without having to use any ETF or wrapper, access them directly. I'm one of those people. I think there's tremendous opportunity there too. I think the product structure that's going to lose out in the U.S. is the mutual fund. For other technical reasons, the mutual fund is still a very good structure to access for 401k, retirement savings plans. In the European markets, it's a little bit different because you don't have the same tax advantage. But ETFs are still, when they're liquid, are still a very good structure. So I'm very curious to see. I don't really have a strong take on the European ETF market. I think there is room to grow. Certainly, we're going to see more of these smart beta and alternative strategies introduced into the market. But again, the distribution incentives in Europe are a little different, and the tax treatment is a little different. I think it's going to be a little harder for ETFs to see that exponential growth that they saw in the U.S. But there still is certainly room to grow. In terms of what I'm going to be doing next, I'm not sure the date that we release this video. I'll shortly be announcing I'll be joining a fintech RIA firm as chief investment officer, and we're going to be building solutions for investors and financial advisors in the U.S. I'm really excited about it. I wish I could talk about it, but I think I need about one more week to be able to do so.
So what we will do is maybe in 2 months or 3, we will interview you to talk about this new project and how you are doing things, because I'm sure it will be totally exciting for us to know what you are doing on that.
I would love to do so. It'd be an honor.
So thank you very much for sharing your ideas, for sharing your understanding, for sharing your experience in the ETFs market. When someone, as I told you, go to your profile, is very exciting to see the things that you have done in this environment, ETF environment, and we are sure that you are gonna do great in all the things that you are gonna start in the new time. Thank you very much for this interview and for being with us.
Really appreciate it. Thank you very much.
Thank you.